Investing can feel like navigating a complex maze. Fundamental analysis is your compass. It's a method used to evaluate a company's intrinsic value. This approach goes beyond simply looking at stock prices. Instead, it dives deep into the financial health and performance of a company. By examining key factors, investors can make more informed decisions. Fundamental analysis helps you understand the true worth of a business. It's like looking under the hood of a car before you buy it. You want to know what you're getting into. This knowledge empowers you to invest with greater confidence. Remember, a successful investor is a well-informed investor. Imagine investing in a company that appears profitable. However, upon closer examination, you discover mounting debt. This scenario highlights the importance of evaluating financial health. A company's financial statements provide a detailed snapshot of its well-being. These statements reveal crucial information about revenue, expenses, assets, and liabilities. Just like a doctor uses X-rays to assess a patient's health, investors use financial statements. By carefully analyzing these documents, you gain valuable insights. Understanding a company's financial health is paramount to making sound investment decisions. Financial statements are the language of business. They tell the story of a company's financial health and performance. They may seem intimidating at first with all the numbers and jargon, but they're essential for any investor to understand. Without them, making informed investment decisions would be nearly impossible. There are three primary financial statements: the balance sheet, the income statement, and the cash flow statement. Each serves a unique purpose. The balance sheet provides a snapshot of a company's assets, liabilities, and shareholder equity at a specific point in time. It shows what the company owns and owes. The income statement, also known as the profit and loss statement, shows a company's revenues and expenses over a period of time. It reveals how well the company is generating profit. Lastly, the cash flow statement tracks the movement of cash both into and out of a company. It highlights the company's liquidity and cash management. Together, these statements provide a comprehensive view of a company's financial performance. Understanding them is crucial for anyone involved in business or investing. Section 4. Key metrics. Gauging a company's performance. Once you understand the basics of financial statements, you can start analyzing key financial metrics. These metrics are essential tools that help investors and stakeholders make informed decisions about a company's financial health. These metrics provide insights into a company's profitability, efficiency, and growth potential. By examining these figures, you can get a clearer picture of how well a company is performing in its industry. Some crucial metrics include revenue growth, profit margins, and earnings per share, or EPS. Each of these metrics offers a different perspective on the company's financial status. Revenue growth indicates a company's ability to increase its sales over time. Consistent revenue growth is often a sign of a company's expanding market presence and customer base. Profit margins reveal how much profit a company generates for every dollar of revenue. Higher profit margins typically indicate better cost management and pricing strategies. Earnings per share represent the portion of a company's profit allocated to each outstanding share of common stock. This metric is crucial for assessing a company's profitability on a per-share basis. By tracking these metrics, investors can assess a company's financial strength and potential for future growth. Understanding these key metrics is vital for making sound investment decisions and evaluating a company's long-term viability. Section 5. Valuation metrics. Are you paying a fair price? Investing is not just about finding good companies, it's also about buying them at the right price. This is crucial because even a great company can be a poor investment if you pay too much for it. This is where valuation metrics come into play. They provide a way to assess whether a stock is priced appropriately. Popular valuation ratios include the price-to-earnings or PE ratio, which is one of the most commonly used metrics. Another important metric is the price-to-book or PB ratio, which helps investors understand the value of a company's assets. And then there's the price-to-sales or PS ratio, which is particularly useful for evaluating companies that may not yet be profitable. The PE ratio compares a company's stock price to its earnings per share, giving insight into how much investors are willing to pay for each dollar of earnings. This ratio is particularly useful for comparing companies within the same industry. The PB ratio compares a company's market value to its book value, which is the value of its assets minus its liabilities. This ratio can help investors identify companies that are potentially undervalued. The PS ratio compares a company's market capitalization to its annual revenue, providing a measure of how much investors are paying for each dollar of sales. These ratios help investors determine whether a stock is overvalued, undervalued, or fairly priced, guiding them to make more informed investment decisions.